Hey guys, I hope you liked my last video on auto loans. In that video, I said something about increasing your credit score, and so that's what today's video is going to be about. I'm basically going to talk about how to win the credit game, hence the name of the video. We're going to talk about the different ways that you are expected to play this credit game. I call it a credit game because many of the things that you think would intuitively make your credit score better won't. It really is a game, and you do need to know the basic rules to be able to succeed at the game. Like I said in my last video, credit is not an evaluation of how good you are with money, it's an evaluation of how good you are at being in debt. With that said, I'm just going to jump right in. When you're looking at this pie chart, I want you to think that there is a huge algorithm behind it, or in other words, a huge math equation behind it. Each part of this pie creates a ratio within and then in comparison to the other pieces of the pie. This pie chart says what's in your FICO score. There are different credit scoring companies, so you have Vantage Score, you have Plus Score. Some of these free websites that you can go and get your credit score on, they have their own credit evaluation system, which basically means that they just have a different algorithm to how they come up with a credit score. Just be a savvy consumer and know what you're looking at. The free sites that I use and work with my clients with is the obvious annualcreditreport.com. That's the one that's provided by the government. And then I use Credit Karma. It basically just gives you your credit score, but it gives you very close to a FICO score, and then it gives you your Vantage score. And then the last one I use is Quizzle.com. That one gives you more of your history than Credit Karma does. I like to use both of them because they serve different purposes as far as giving you information about your credit for free. I only suggest paying for it on a monthly basis if you are getting ready to make a large purchase or really just trying to work on your credit score and report, because otherwise, it's not going to be changing very much. With that said, I definitely believe that you need to be looking at it every 3 to 4 months because someone could steal your identity, and you just need to maintain an eye on your credit and your credit report. Make sure nobody is using it but you, and then make sure that you're using it correctly, and make sure the credit reporting agencies are reporting correctly on your behalf. When you're looking at this pie chart, you'll see that 35% of it is your credit history. If you take the 35%, that's your payment history, you have to understand that it's evaluating how many times you've made on-time payments in comparison to how many times you haven't. So if you only have one payment and you paid it on time, you have 100% on-time payments, okay? If you have anything negative in your past, then you need to build up those on-time payments to be able to counter any discrepancies in the past, any late payments or anything like that. The more on-time payments you have, the less each not on-time payment will affect you. Back to the pie chart. So 35% is your payment history. Obviously, how many times have you paid on time versus how many times you have not. The next biggest chunk is the amounts owed. If you go out and buy a car today, this will actually reflect negatively, because if you purchase the car for $20,000, you make one payment, you probably still owe $19,800 on it or something like that. So you virtually owe as much as you borrowed. If you would like that to start reflecting positively, get some of your installment loans paid down, get some of your credit cards paid down. As far as credit cards go, you want to keep them at 10% or less. The 30% probably made up by the credit card companies. That is not going to help your credit score by having 30% balance on your credit card. I always say at the most 10%. You don't necessarily have to hold a balance on your credit card. Some credit cards will report positively if you have zero balance. For instance, my Capital One card, if I don't use it, owe zero, paid zero, you paid on time. You need to know what your credit card will do. For the most part, you can just keep it below 10%. If you're new to this whole game and you went out and you got a credit card with a $500 limit, then you should only be spending $50 on it. So that's pretty much a tank of gas. That's probably what you said you were going to use on it. So just stick to what your plan was and only spend 10%. And if you max out your credit cards, it looks really bad. So if you are in the arena where you have a $3,000 limit and you owe $2,700, looks pretty bad. You need to pull that back down. And if you don't know what your limit is, you're in big trouble. You need to know those things. This is part of your responsibility when you signed up for the card. The next big piece of the pie chart is length of credit history. Now this one can be hard for younger folks because, you know, we are only allowed to start building credit at 18 or 21 depending. The way that we best combat this is through credit cards, okay? Installment loans are like car loans. You get the whole amount of loan and you pay it off in installments. Revolving debt are credit cards. So you use, you pay, you use, you pay, you use, you pay. So you can basically have a credit card forever. If you don't have a credit card, this isn't your opportunity to rush out and get one. I think you should still be a savvy consumer, make good choices. But the point is that if you do get a credit card, make sure it has no annual fees, a low interest rate, a good reputation, and then you want to make a lifelong commitment to that card. Just make sure that you're planning on having that card for a long time, treat it right, keep it at 10%, pay it on time every month. If a credit card can be a curse and a blessing. You can either pay it on time and it helps your credit, or you cannot pay it on time and it can destroy your credit. So you have to make sure that you're going to be ready before you make that type of commitment. New credit is 10% of your pie. It also affects other pieces of your pie. So you want to just make sure that you're making good decisions on when you're getting new credit. New credit pretty much hurts your credit score for numerous reasons. If you look at the other pieces of the pie, amounts owed, right? If you go out and get a new car loan, then all of a sudden you owe a lot more. You have no payment history. That's your first payment on it. Length of credit history, it's an average as well. So if you have a brand new account with 1 month on it and a credit card with 12 months on it, they average those together and now your length of credit history is only 6 months. Not to do it when you go to Express and there's a 10% off if you sign up for the Express card. That would not be the appropriate time to go get a new credit card. And the types of credit used, I've talked about 2 of the main types of credit used: installment loans like car loans, and then revolving debt like a credit card. The other type of loan is an installment loan. It's just a huge one. It's a home loan. For some of you guys who are sitting around 750 and you're wondering, why can't my credit score get any higher? Chances are they want to see a home loan on it. Clearly that's not a reason to buy a house, so don't rush out and do that. But buying a home down the road after you've paid some of it off and it's no longer a new debt will likely help your credit score significantly. I know that was kind of a lot really fast. I normally teach like a 45-minute class on credit, and I will try to follow up with a little bit more information later. Please leave me questions if I left any holes in the knowledge that I just provided. I'd like to know what those are so that when I do come around to follow up on this video, I make sure to answer some of your questions. So, bye. We'll see you next week.